You're listening to the Savings Tip Jar with Dom Beattie and Denise Raywood, brought to you by Savings.com.au, your home of savings news, guides, and product comparisons. G'day, welcome to the Savings Tip Jar. Great to have your company for episode 159 as we digest the dollary do's and dollary don'ts of the week in Aussie finance. I'm Dom Beattie, the editor of Savings.com.au, and back from a 2-week break, which means we have returned to regular programming with the full course of savings news and a dollar dialogue, but hope you enjoyed our mini episodes over the last 2 weeks. Back alongside me is our senior finance journo Denise Raywood, and this week we'll be discussing the sharp drops in longer term deposit rates. Does that mean that banks think big rate cuts are coming? Also, how long will the property market downturn last and how far will it fall? A new report from Domain suggests that if history is any guide, the downturn will be shorter and shallower than the upswings. Plus, the surge in SMSF lending for residential investment property as trustees race to take advantage before the ban kicks in. Then for our Dollar Dialogue segment, we'll talk to AMP's Chief Economist Shane Oliver on whether Aussies really had it better in the so-called good old days. Don't miss that chat. But first, let's check in with my terrific co-host Denise. G'day Denise, how you been?
Yeah, very good, Dom. Been a bit busy while you've been away, actually.
Yeah, there's been a fair bit going on, has there?
Yeah, the usual things, just the usual things.
The usual things. Well, what was not so usual was that, sudden, unexpected change to SMSF lending, which we will get into later. But I guess, are you keeping warm at the moment? Because it is quite chilly at the moment, but I understand that's one of your savings tips.
Yes, my savings tip. Okay, you're going to say, what does someone in Queensland know about heating tips? But I'll have you know that I have lived in Shepparton, Melbourne and London. So I do know about heating. In Queensland, my heating tip is go outside because it'll be warmer outside than inside your house. But for those who do have heating and pay for it, it's a major expense. We've had our first little chilly blast in Australia. So the old ones, just heat the room that you're using, so your living space if possible, and good old door snakes and those draft proofing strips that you can put on doors and windows. I can remember using those when I lived in very cold climates. Makes a huge difference. I think I've seen up to 25% of keeping heat in the room. And then, of course, when the sun goes down, you keep your curtains open while the sun's up, and then you shut everything down to keep heat into the room. And I think that's glass. You can lose 40% of the heat of the room through glass. So there's just some little tips to just sort of put into your routines, and I'm sure people that live in cold climates do that unless they're very rich. And my own approach in wintertime, I just wear winter clothes all the time inside the house, and my personal favourite work from home blanket, which I use as a sarong. For those who are watching, I'll just show you that now. I have been known to walk down the street in that. It's just a very handy thing, and I never think about, maybe getting a heater. No, that's just the cheapest way.
Oh, there you go. No, I like to hear it. And, well, I guess for those that do, perhaps those from the southern states that scoff at Queensland winter, it does actually get pretty cold in the winter because the houses aren't built for it. They're built to withstand the heat and to keep us cool through the summer. But that means when we do get a cold blast, it actually does get pretty cold in a lot of our houses. And I think that's to an extent the case also in Melbourne. I think I remember reading someone online saying they were from Europe but they'd never felt colder in their life than when they spent a winter in Melbourne. And these people were from like Switzerland or France or something. Because, our houses in Australia are sort of not really built to
They're not very good.
They're well.
Very good.
Particularly so in Queensland with those old Queenslanders. They do keep us nice and cool in the summer, but they can get very cold and drafty.
I've just got a bit of cement sheeting behind me. There's not much there. Yep.
Yeah, my feet get so cold as well. No matter how many layers of socks I put on. Certainly some
try some ginger
slippers can work quite well. Try some what? Some gin.
Yeah, good for the circulation.
While working. I'm not sure about that. Maybe it'll make for a more interesting podcast. Might have to try that next time. So my savings tip is Just when looking into an Airbnb, consider booking directly with the hosts rather than through the Airbnb platform. And this tip was prompted by a recent stay I had in a beautiful Airbnb during my break in Point Lookout on North Stradbroke Island. Had lovely views of the ocean, spotted loads of whales, but in the house I noticed there was a little note with the owner's phone number, encouraging guests to rebook with them directly next time to avoid Airbnb fees. And that's something I hadn't actually considered before. So I looked into it, and apparently Airbnb does charge guests a service fee of 10 to 20% of the subtotal, while also charging the hosts a commission. So by booking directly with the hosts, you'd be cutting out the middleman, and the host would be likely to charge less because of that. And of course, with something like this, though, you do need to do the pros and cons of going directly. Airbnb does have a built-in security and refund policy, so you might be taking on a bit more risk by going direct. So, but perhaps it's better to do this direct booking when rebooking a place you've already stayed in before, because you and the host have established that trust between yourselves. But that is something I hadn't really thought about before. I wonder, have you ever tried doing that, Denise?
I have done a story in the past, not too long ago, actually. It was for one of our other sister publications, Your Investment Property, about Airbnbs, and I was surprised how much of a cut they take for just running the platform. And you're right, there are some inbuilt reasons why it may be better to go through those platforms, but it adds a bit of a cost on and takes a bit of a whack out of the proceeds of the people that own the properties as well. So I definitely think if you can go direct, I think the more that we can do face-to-face and people gaining trust with each other, it's not a bad thing in the world today.
Yeah, certainly. But the place was beautiful, and maybe if we are on Stratty, we will consider staying there again. So I did save that number, and the hosts were lovely as well. They'd provided all these recommendations, and turns out those recommendations were all good ones too as well. They were recommending this place that sells these like prawn and avocado rolls, and we thought, those do sound.
I know those.
Have you had those? Those
I know those.
Yeah.
I love Stratty, yeah.
Oh, man, it was so nice.
Yeah.
They were quite pricey. It was like $16, but they were good. And apparently they've been mentioned in this famous Melbourne food blog. So they are quite well known. But, and they even recommended just their neighbour, just down the street, that sold seafood, and to go to them and buy fresh seafood, and even to mention the host's name as well, and maybe they'll be extra friendly to you. They were great, and I thought, I probably would book directly through them next time. So that's my savings tip. Consider booking directly rather than through Airbnb. Right, let's get into the Savings News Roundup, which we haven't done for a couple of weeks, just while I've been away. You start us off, Denise. What have we got?
Well, I just have noticed just only probably less than the last fortnight, actually. I've just noticed we're starting to see some term deposit rates, and that's particularly longer term, so 1 to 5 years, say, and some home loan rates dropping across the market. And according just to our Savings.com.au database, it's just sort of gained momentum, as I say, just in the recent past, say the end of June to early July. On Tuesday, we saw the market's sort of long-standing highest term deposit rate, which was Rabobank's 5.70% per annum for a 5-year deposit, and that was for a big amount, over $500,000 to $2 million. That's taken a 50 basis point haircut to 5.20% per annum, and that's with annual interest. That's a fair slice off that. There's been some other term deposit rates and fixed home loan rates coming down, and that sort of indicates where banks and lenders believe rates are going to be in the future, because those rates are set with the future in mind. The interesting thing, though, with some of the recent home loan rate cuts, they have not been fixed rates. We've seen a couple of variable rates coming down, and I think that's more an indication of what's been happening on the market. Coming up, we're going to talk about, the property slowdown. I don't think there's a lot of people out there buying or lending at the moment, so you can see why some lenders are, sort of putting some bait out there. And this includes a couple of the mid-tier lenders, so the ANZ-owned Suncorp and Bendigo Bank. They've both sort of taken some points off their lowest rates. And for Bendigo, it was quite substantial, a 15 basis point cut to its online lowest rate home loan. 15 basis points out of cycle is, that's quite notable. So you'd have to say that there's some market reasons for lenders throwing a little bit of a lure out there for any business that is around in the property market at the moment. It's something that they, can promote and maybe drum up a bit of business in a quiet time.
Yeah, certainly. No, it's been quite interesting and almost quite a sudden change that we've gone from, so often we're talking about nothing but rate hikes on everything from term deposits to home loans. But now it seems like we're reporting more and more on rate cuts across those products. So you just wonder if we are now at that point in the cycle where we're heading back towards all the rhetoric being about rate cuts. But, you still got the likes of Westpac still thinking that, still quite insisting that there will be 2 more rate hikes this year. So who knows what the go is there. But I don't know, you just get that feeling now that it's like, okay, maybe rates are going to be steady this year and then we'll be starting to gradually come back into a rate cutting cycle as we head into next year, which is what those other economists from the other big banks are implying will happen. But yeah, that seems to be the indication based on these rate changes. But I guess if you think about it, it's a 5-year term deposit rate from Rabo, and they've just cut 50 basis points. So in effect, they're believing that at some point in the next 5 years there will be 2 rate cuts. That makes it sound not that significant, but it is just quite rare that we see banks do just a sudden 50 basis point cut to a term deposit. Usually it's it's like death by
1,000 cuts.
Yeah. It'll be like 5 or 10 basis points at a time. But yeah, just more on the property market for the next news item. With all the gloom about the property market slowdown in the media, Domain released a report into Australia's property market downturns, pointing out that on a historical basis, they don't last very long. The report found Australia is now entering its 9th property downturn in 3 decades, and all 9 have been triggered by much the same things: higher interest rates, tighter credit, and shifting buyer sentiment. Running the data, Domain found the average downturns have seen national values decline by 2.9% over roughly 8 months, while the typical upswing delivers around 32% growth over nearly 3 years. In other words, the downturns are both shallower and shorter than the market upswings. The data also shows all 8 previous upswings have been followed by a recovery that not only reversed losses but pushed property prices to new highs. What do you make of that, Denise?
Yeah, it's I looked at that data, and it's worth having a look at that news story just to see what some of the figures are and some of the graphs. It does make sense. I mean, we're yet to see how it plays out. The tax cuts can, have a significant effect, I think, in the short term. It sort of may knock investors out of the market, and that might be a bit different than what we've seen. Although, we have experimented before with cutting negative gearing in the late 80s from 85 to 87. It did get reinstated after that, though. Yeah, let's see how it all plays out. We've started to see just in the last week, actually, some rental reports coming out, and they'll be published on Thursday because a lot of them are embargoed until that date. Already we're starting to see rents climbing, and that's from quite a few different data sources. So I think that was the reason in 1987 why negative gearing was reinstated. There was some concerns about rents rising, not in all capital cities, but in Sydney and Perth particularly at that time. And I think the domain data does point that out. We have got different markets in different capital cities. So, yeah, I'm very interested to see how this downturn plays out. It's a good time to buy, put it that way.
Yeah, well, I mean, yeah, the time to buy thing, I always think it is totally subjective. It's totally up to when, like, as soon as you've got the deposit savings and you found a house that you like, and you can comfortably afford the repayments, that's the time to buy. But yes, it does, it's an added bonus when you are in a quieter market and there's less competition, fewer buyers.
Don't feel the pressure. Yeah.
That's right. That's it. But yeah, I mean, by the time this podcast does go out, that embargo should be lifted on that rent story. So listeners should have hopefully read the story and seen that data that is showing that rents are picking up quite dramatically on the back of those changes to property taxes. On to the next news item, Denise, SMSF funds.
Yes, well, this happened while you're away, Dom. Self-managed superannuation funds are, in a bit of a lather at the moment, particularly those that are scrambling to finalise any residential property purchases they may have had in train or were thinking about. Were hoping to get into their investment portfolios as part of the federal government's federal budget. Getting that through the Senate. There was a bit of a deal done with the Greens. Basically, it means that the working date, we think, is the 10th of August. From the 10th of August, there'll be no more residential property borrowing that SMSFs are allowed to do. It doesn't mean that they can't buy residential properties. They can still purchase them outright. They're just not allowed to take out any loans to do so. And they can still purchase commercial property, which a lot of SMSFs do because they can use them as their own sort of business premises as long as they pay market rent. Commercial lending is still going. Residential lending will be knocked out of, the picture. It will probably mean there'll be fewer residential properties held by SMSFs. The government said there's only about 4,000 residential property loans per year. The SMSF sector has said that this is grossly understated. But the key is if you do have a self-managed super fund and you were thinking of adding a residential property to your portfolio, if you don't have a signed contract already, you better get going and get one. There'll be a bit of a window where you can get these transactions and the property transfers in train and settled, but the window is fast closing. So it won't affect too many people perhaps, but SMSFs will have known about this, and the ones that are scrambling, and apparently the SMSF sector has been very busy getting this sorted out. So, yeah, that was a bit of an out of the left field one, Dom.
Yeah, well, we're seeing the impacts of that announcement on our site even as well. We at Savings.com.au have a SMSF home loan comparison tool, and it's obviously quite a niche product, so it doesn't get a whole lot of action. But lately, we've just seen that substantially ramp up, and there's a lot more interaction with our comparison tool at the moment, and clicks as well. So people are suddenly shopping around, trying to find an SMSF home loan, so they can snap up a residential property while they still can. But we as we've discussed off air in length, we don't know exactly when that ban kicks in, and no one seems to know. You've called around, you've spoken to several the advisors for these politicians, and they all don't seem to know either. And we haven't been given a firm date yet when that kicks in. But there's that working date of the 10th of August, 2026. So
I think that's the safest working date, the 10th of August. If there's any bonus days, and we're talking days, it would only be days. 10th of August is probably the safest deadline to work towards.
Just over a month away. So naturally, people are scrambling trying to get those purchases over the line while they still can. So interesting one that. But that was a bit of a shock, that news that happened while I was away, but I did get alerted to it and did think, oof, geez, what's that going to mean? We'll see if we can get someone on the podcast at a later date, hopefully soon, to talk about some of the ramifications of that quite drastic and sudden and unexpected change from the government there. All right, I think that wraps up the main money matters of the week this week. So let's talk to our guest for this week's episode in our Dollar Dialogue. All right, time for our Dollar Dialogue segment. And this week we're joined by an old friend of the pod, Shane Oliver, Chief Economist with AMP, who's going to talk to us about the good old days, or rather the so-called good old days, because according to a new report from Shane, there's reason to doubt whether Aussies really had it that much better back then. Welcome back to the Savings Tip Jar, Shane.
Thanks, Dominic. Great to be here.
Now, before we start, Shane, do you have a savings tip for us?
Well, my savings tip is a bit different to what I would normally say, but because we are so obsessed with the budget tax changes at present, and this is not to deny their significance, and I'm not great fans of them, but my savings tip would be don't let tax dominate your investment decisions. Yes, it is a factor, but ultimately the investment has to stack up on its own. Otherwise, you should be looking somewhere else if it's just all about tax. So that's bottom line for me this week. Don't let tax dominate.
Yeah, absolutely. I think that could apply to a lot of things. You see a lot of people thinking, I should go out and buy this thing because then I can, get a big tax deduction. It's like, well, no, it's still going to be costing you a fair bit of money. Or people sort of questioning, I don't know whether to take on this extra shift at work because then I'll get taxed more. It's like, well, no, you're still going to get more money out of it. It sort of frustrates me a bit. People are so opposed to pay.
It's important, but it's one of many factors.
Exactly. Now, Shane, according to your report, Aussies are recording pretty low measures of happiness. But apparently we were all a lot happier during the pandemic, funnily enough. And there's also low consumer confidence. So we'll start on the current situation before we get to the good or bad old days. What's behind the pessimism at the moment, do you think?
Look, I think there's a bunch of things, but I think the main issue has been that over the last 5 years, or ever since the pandemic, the cost of living has gone up dramatically. The CPI, as measured, has gone up something like 25% over the last 5-6 years. And that's just average prices. I know you're going to find lots of examples of prices that have gone up more than 25%, but people's wages have only gone up about 18 or 19%. So real wages have fallen about 6% over the last 5 or 6 years. And that contrasted with the period, say, before the pandemic, where usually, not every year, but usually wages on average in Australia rose faster than prices and costs. So bottom line is people feel they're not getting ahead, that the cost of living is too much, that they're struggling, and all these issues about inflation, rising interest rates, and so on are part and parcel of that. I mean, there's a bunch of other issues going on as well. Obviously, the global environment creates a lot of noise and angst, and that does feed into the cost of living to some degree. And I think the bigger issue in Australia, one of the big issues in Australia for young people, is the unaffordable nature of housing. So that's one big factor as well. But that's probably more of a longer term issue. It's not just the last 5 years that housing's been an issue. It's been an issue, I think, for the last 10, 15 years.
So were we actually better off in the good old days? What was better in the good old days?
Well, there's no doubt. If you define the good old days for a baby boomer, you're probably thinking 60s and 70s. If it's a Gen X, you might be a millennial, you might be going back to the 2000s. There were some things that were better back then. The cost of living was lower. That doesn't necessarily mean our wages were better, but our cost of living was certainly lower back then. And consumer sentiment on average was higher. Measures of happiness go back to the 2000s. We don't have happiness measured back in the 70s, but happiness levels were quite a lot higher than they are today. And interestingly, it's young people who are less happy. It used to be this sort of classic U-shaped thing that happiness was high when you're youngish, like 20, 25 or something, and then it dips when you become middle-aged because you've got all these stresses of a mortgage, and then it goes up when you get older. Your kids are under control, your mortgage is under control, and it's before your health starts deteriorating. These days, it's actually lower now for young people. They're less happy. But I think one of the big things on that front is just housing. Housing affordability has collapsed since the 70s and also since the 2000s. These days it takes you about 11, 12 years to save for a typical 20% deposit. We've had to introduce that silly 5% low deposit scheme to overcome that. But if you go back to the 1970s, it was less than 4 years to save for a deposit. And in the year 2000, it was about 6 years. The average house price to income ratio is about 3 times what it was in the 1970s, and home ownership rates have generally come off a little bit. So bottom line is housing was a lot more affordable back then. And we also paid less tax as a share of our income than we do today.
Yeah, absolutely. I mean, like housing, I can sort of understand that. Like housing is such an emotional thing. We associate it with comfort and safety. So I can understand why maybe people, look fondly upon the earlier times when things seemed so much more affordable and you could buy a house much more. But what struck me actually from your report is how much, how little actually home ownership rate has dipped, considering that significant ramp up in the gap between the cost of buying a house and the typical wage. Why do you think it hasn't fallen off that much?
That's right. If you read a lot of the media commentary, it's collapsed, whereas in reality it hasn't. It has come off a little bit. In the mid-70s, it was about because we only get figures on home ownership every 5 years with the census. I mean, there's estimates in between, but it's usually on the back of the census. So in mid-70s, it was about 63%. In the year 2000, actually using 2001 census numbers, was 66%, and now we're back to 63. So it's come down on a trend, and I should point out the trend high point was in 1966 when it was around 73%. So this is in the post-war years, when the family home was seen as the key to success and stability and security. Australians really loved their home in that era. If you watch that film, I forgot the name of it now, but there was lots of films back then about building houses. They're a weird mob, I was thinking of.
Right,
a lot of people probably have.
I've read the book.
Read the book. The guys out there in suburbia building homes. So that was what a lot of Australia was about, building the family home. And then, of course, as time has gone by, housing has become more expensive, so we've seen a bit of a slide from them. But it's not just that. It's that people spend more time at university, so they take longer to start their career and start their family. So that means you get a house later. So that adjustment has been occurring. And I think younger people today regard housing as not only too expensive, but they also regard it as an encumbrance. You want to travel more, you want to have more experiences when you're younger, and renting is more amenable to doing that than ownership of a house. So there's a bunch of factors behind that. But the other thing is that Australians still love their housing. It's still 63%. It's not 45%. Or some collapse, as you're alluding to, Dominic. It's still relatively high compared to many other countries. So even though housing has become less affordable, we still want to get into it. And that's, I think, showing up in those numbers.
But outside of housing, Shane, there's got to be, it's very hard. I mean, I was alive during those times, the 60s and the 70s. It's very hard to compare what Australia was like back then to now. So, what's better? There must be a lot of things that are better.
I think a lot of things are better. I mean, there were some other things which I would say were good. There was a greater sense of community, or that was my experience back then. We think about Lions clubs and Rotaries and all those sorts of things, greater membership in golf clubs and so on. But these days, that's partly, what's partly happened there is changed expectations of men. Men back then could spend the whole of Saturday afternoon out sailing or playing golf. These days, they're under a lot of pressure to come home and look after the kids or share the burden of raising kids. And that's not necessarily a bad thing, but if I look at the things that are better today, per capita GDP has grown immensely, but let's translate that to real after-tax disposable income. It has doubled compared to where we were in the 70s. We've got lower inflation than back then. I know we complain about the cost of living and inflation. Today it's around 4%. Back then it was the high point around 17%. I think the average through the 70s was about 9 or 10%. So very high inflation. Even in the year 2000, inflation was a little bit of a problem, not a huge one, but nevertheless, there was a bit of an issue there. Unemployment today is generally a little bit lower than it was back then, so that's certainly good news. We've got a greater proportion of the population in jobs. It's now around almost 64%. Back then it was about 59% in both the 70s and the year 2000. And one of the big changes has been the rise in female participation in the workforce. So some of us look back to that period and say, this is fantastic, but, the opportunities available to half the population were nowhere near as great as they were for the other half of the population. And so you could argue it wasn't exactly fair. Life expectancy has exploded. Government spending on health and aged care, disability care, welfare and so on has doubled compared to where it was in the 70s and is also increased compared to where it was in the 2000s. So government takes care of a lot of issues that weren't looked after back then. Life expectancy for a male back in 1975 was about 69 years. Now it's 81 years. For a female, it's gone from 76 years to 85 years. So we're living longer lives, often healthier lives. Government's looking after us to some degree as well, not just in welfare, but road deaths have collapsed. They're about one-fifth of what they were per 100,000 people. Number of road deaths are about one-fifth what they were in 1975. We were out there in 1975 with those fantastic cars that look beautiful on the road, lots of bright colours, lights. My phone just went off then, so hopefully that's seamlessly turned it off. But road deaths today is running at around five per 100,000. So we've gone down from 27 per 100,000 to 5 per 100,000. Homicide rates have halved compared to back then. So there's a lot of things that have improved compared to back then. But oftentimes, we gloss over it and think, well, that was the good old days. Life must have been better back then, but in many ways it wasn't.
Yeah, certainly. It does sound like outside of housing and the big pressure of having a big mortgage these days, we've got a lot to be happy about these days. And I just think it's just like the rose-colored glasses and the nostalgia effect when we think back, it was so much better back then. But I think we should sort of live in the present a bit more and think, we've got it pretty good. And, one of the telling stats out of that piece you did as well was number of overseas holidays that the average Australian's taken as well. And I thought we're still enjoying our lives a lot, but it must be the impact perhaps of social media that's making everyone have these higher expectations, watching all these influencers online. Is that your impression that's the impact here?
Yeah, it is. The overseas holiday number struck me as very significant. In rough terms, an average Australian would go on an overseas holiday once every 15 years, 50 years ago, whereas nowadays it's almost once every 2 years. And you can just see that. You go to the airport, see the number of Aussies going on holiday. It's exploded. And this guy used to work for Qantas, my neighbour, was telling me how when he started his career, when they did go on holidays, they'd go to Fiji or somewhere, and Fiji is a fantastic place. But now it's less about Fiji. It's also about Europe and lots of Asia and so on. So that I think has been a big thing that we often gloss over. And I often wonder that the point of going on an overseas holiday is to make us realise how good life in Australia is when you get back. Everything operates relatively smoothly. Got a great healthcare system compared to other countries. Yeah, the roads are pretty good. The weather's mostly pretty good compared to many other countries. So I reckon social media does have a big role to play on this front. Social media is all about clickbait and rage and people with problems espousing on those problems. And, of course, when you watch social media, maybe you kind of think, well, if I don't have a problem, then there's something wrong with me. I should get one too. And so this sense of grievance tends to take over. So if you had traditional media, yes, it was always true. Bad news sells. The cover story in the evening newspaper, the newsstand was always invariably something negative because it would more likely sell than positive news. But I think that's been magnified by social media. You do get more clicks if you come up with a bad news story than a good news story, or if you're just telling it like it is, you'll get more clicks. You'll get far less clicks than if you're telling everyone something's bad. So I think that's played a big role here. There's no doubt there are issues with cost of living. That is a big issue, and housing affordability. But I think beyond that, things aren't too bad. But we've sort of, forgotten the way things were back then, forgotten the improvements that have occurred. I mean, if you give another example, I noticed this, and I was incredibly surprised by this. The suicide rate today is lower than it was in the year 2000 or the mid-70s. You look at a graph on it, it is available there if you Google suicide rate, and I have it in the report as well. It does have big cycles. It was actually higher in the mid-60s or into the late 60s than it is today. And suicide is a horrible thing if anyone knows of it, and I've got family experience of it. But I think we tend to often exaggerate these things. Yes, they have gone up, but not in the last few years, but they're still below previous highs that we've experienced in this country.
Okay, so it sounds like, are we just whinging more? Oh, we've just got too soft. Is that what it is?
Well, I do wonder about that, whether we've become a nation of whingers, Denise. It's sort of, maybe we've just got too much time on our hands to spend looking at other things, and there's ways to do that that did not exist in the past, and those ways also give us a way to whinge. You know, I've heard this example of a taxi driver who'd be listening to talkback radio all day. You'd get in the taxi and they'd have a whinge and tell you these things, but that taxi driver can now be magnified 100 times by going on social media, whereas before it was very narrow and wouldn't go too far. Whereas now you're exposed to this whatever you do. If you go on talkback radio or if you go on social media, you get a lot of negative stuff. And maybe it's trying to adjust to social media. I think there's huge benefits of it. This podcast, for example, helping to inform people. There's huge benefits of social media, but unfortunately it's gone down a path to some degree that a lot of the rubbish on social media has just made things feel bad, and maybe we have become a nation of whingers, and we often fail to recognise that, well, actually things aren't too bad.
Well, hopefully, those that are discovering this podcast via social media, hopefully we're the exception to that rule, that social media, we're one of the rare bright spots of social media and
that's right.
online media in general. But no, maybe that is the solution. Get off social media, block your ears, don't expose yourself to all the horrors of the world. We do try to keep things relatively upbeat on the Savings Tip Jar. We don't get too down in the dumps, even though we do report the hard stuff too. But I mean, this is, I've appreciated all your insights though, Shane. That's why I wanted to have this chat really, is I thought we do have a lot to be happy about in this day and age, and it's not highlighted enough. And I really appreciated seeing that report come from yourself. So that's why I was so keen to get you on the pod this week. So yeah, once again, Shane Oliver, thanks so much for joining us on the Savings Tip Jar podcast. Really appreciate those insights.
Thanks, Dominic. Thanks, Denise. Thanks for having me.
Yeah, thanks. You cheered me up, Shane.
That's great. That's great.
Be happy. All right. Yes, that was AMP's Chief Economist, Shane Oliver. And on that cheery note, that wraps up another episode of this Savings Tip Jar podcast. If you're feeling particularly cheerful, please smash that subscribe button and give us 5 stars on Spotify or Apple or whichever podcast platform you're listening on, or all of them. If you want to get in touch, shoot us an email at inquiries@savings.com.au. That's inquiries with an E. And if you want to follow savings.com.au across social media, feel free to do so across Facebook or X, Instagram, TikTok, and also give us a follow on YouTube as well. And we'll catch you next time. Happy saving. Goodbye.